Hey guys, it's Sean at eMiniSchool. It's Sunday, May 9th. Okay, in today's video I want to go over the 120-minute Forex chart. So we'll go back a couple of weeks and we'll just kind of follow the chart. So starting here, we had a sell signal. Okay, this is not a true signal. Aggressive traders could take this short, but we really want the correction pattern to complete and for it to really pull up a little bit more than here. So from this sell signal, okay, we come down, we have a buy signal here. The trend before this move was up. Okay, so this trade right here was actually counter trend. So the actual trend was up. So this is the long signal stop above structure or below structure here. Okay, it pulls up. Then we have another signal here, long stop here. Okay, it comes up, makes a new high. From this high, it comes down, comes up, attempts to break this high. Okay, rolls back over red. Here's our short here, stop above structure there. Okay, comes down, comes up, and then it starts contracting. Okay, so the market's either expanding or contracting. Okay, when it's contracting, the range is getting smaller. Okay, and it's coming out of an expanding. So it's either expanding or it's contracting. Or you could say it's going sideways when it's contracting. Okay, but it's still in a bigger pattern. You just have to go up a time frame to see it. So blue bars, indicator low, big move starting. Okay, this is key because this will tell us that the contracting market is getting ready to expand. Okay, a lot of traders lose money in contracting markets because you try to play the break here or try to short it here. Okay, it comes back and it just comes right back up into the range. Same thing here. It comes down, comes back up, goes up, comes back down. It's very frustrating. So it's better to wait out contracting markets instead of getting in, trying to predict the break. Okay, you'll be in that trade for a long time, and the longer you're in it, the less odds you're right come into play. Okay, you could still be right on the direction, but you could get faked out a couple times. Okay, and then you say, "Oh, forget it, it's not going to go," and then ultimately it goes. You say, "Oh, I should have caught that. I knew it was going to do that." So we really want to avoid all those negative thoughts. Okay, so it's better to wait for blue bars to tell us that we're going to expand. Okay, so we expand in the direction before the contraction, comes up, rolls back over red. Okay, makes a pretty big move. I'm not going to go over how many pips this is. Everyone can see on the video. So the point, I don't want to just make this a video saying, oh, you could have caught 400 pips here and 300 pips here. You might not trade a 120-minute chart. Okay, so but the point is, you really want to trade multiple time frames because even if you don't trade or enter off of a 120, okay, you want to know the direction of the 120 if you're entering on a 5-minute or a 15-minute. Okay, and only trade in the direction of the 120. Okay, meaning 120-minute bars are red going down. You know instantly what not to do, which means go long the 15 or the 5-minute. Stick to the bigger trend. Okay, price comes down. Blue bars, indicator high. That means this move most likely over. Okay, so if we were short on this bar coming down into this, as soon as we get blue bars, we trail the high of it, and we would have been taken out right there. Okay, it's emotionless. You just do it every time. Can it go lower? Yes, but chances are it's not going to go much lower. Okay, and the trade is from here to here. It's not from here to maybe here if it goes a little bit lower. It's too risky. Okay, blue bars, when the indicator is high, means the move is going to end. Okay, that does not mean go long. Just because this move down is ending, that is not a long signal. That's a very aggressive way to trade, picking the bottom. Just like we had a video on Apple, the daily chart, there was blue bars at the high. Okay, I did a video on it. Then the next day, Apple comes out with earnings, and it goes up 20, 30 points. Okay, the point of that video was just saying Apple is peaking. The trade on Apple, it was like a 60-point run. It's best to get out. Earnings yes, it popped, but it could have came down as well. So it's best just to do it every time. But just know it's not a long signal when the indicators are high and we're at a low. Okay, it's very aggressive. The long signal is the second set of greens, which is here. Okay, here, this pullback's not deep enough. We want to pull back, go long here. Then the chart gets a little bit small right here because there was a massive sell-off. So hopefully you can see it. Basically, we have a sell signal here. We have a sell signal here. And we have a sell signal here. Okay, on each sell signal, our stop is right here. It's right above last green, last structure right there. Okay, and there was a huge sell-off. So, blue bars, indicators high. So we're going to trail the stop to there. Next bar, we're going to trail it to there, and we get taken out right there. Did we catch the absolute low? No. It's not going to work like that consistently. But this is a very easy way to manage the trade. And the bars stay red all the way down to keep you in. To make that risk really worth it. To make the reward worth it. We don't want to get in. It moves a little bit. We see our profit and loss. We just take it because we're up money. Because we're not used to being up money, so we just have to take it. Really, to get to the next level, you really have to hold the winning trades. So hope this chart helps on the FX, looking kind of at the bigger time frame. Have a good weekend.